Something extraordinary is happening in the precious metals market right now, and if you're not paying attention, you might miss the most significant wealth transfer opportunity of this decade. The numbers don't lie, and what I'm about to share with you isn't speculation or theory. This is verifiable data that anyone can check, yet somehow the mainstream financial media continues to ignore it. We're witnessing what could be the setup for the largest silver market disruption in generations, and the clock is ticking faster than most people realize. Before I dive into the specifics, I want you to do something important. Hit that subscribe button right now because Element Access is dedicated to bringing you the financial insights that actually matter, not the sanitized version that Wall Street wants you to believe. Turn on notifications so you don't miss what's coming next, because things are moving fast and you need to stay ahead of the curve. This isn't about entertainment. This is about protecting your wealth and understanding what's really happening in the financial system. Let me paint you a picture of what's actually happening at the COMEX exchange. This is the primary global marketplace where silver prices are supposedly set based on supply and demand. According to their own public records, they currently hold between 103 and 120 million ounces of registered silver. That's the physical metal actually sitting in vaults available for delivery to contract holders. Now, here's where it gets interesting. The total open interest, meaning all the futures contracts promising delivery of silver, stands at 429 million ounces. Do the math with me for a second. They've promised to deliver 429 million ounces, but they only have about 103 million ounces available. That's more than a 4-to-1 ratio of paper promises to actual metal. Think about what that means for a moment. For every single ounce of real silver in those vaults, there are 4 ounces worth of contracts circulating in the system. If even a fraction of those contract holders decide they want physical delivery instead of a cash settlement, we have a serious problem. This isn't like stocks or bonds where everything exists digitally. This is physical metal that has to be pulled from a vault, weighed, verified, and shipped. You can't just create more of it with a keystroke or a computer entry. And here's what should really get your attention. In January of this year alone, 40 million ounces of silver were demanded for physical delivery. Let me put that in perspective for you. In a normal month, you typically see 5 to 10 million ounces standing for delivery. 40 million ounces represents a 400% increase from the historical average. That's not a small deviation. That's a fundamental shift in behavior. Someone, or more accurately, multiple entities with serious financial resources, are calling the bluff. They're not accepting cash settlements. They're demanding the actual metal be delivered to their possession, and they're doing it at scale. Now, I want you to drop a comment below and tell me what you're seeing in your area. Are premiums at your local coin dealers going through the roof? Is inventory getting harder to find? Are you being told there are delays on certain products? Share your experience, because this helps all of us understand what's happening on the ground level across the country. The comment section is where we build real intelligence that no corporate media outlet can control or spin. Let's look at the price action because it tells an incredible story that the mainstream media doesn't want to acknowledge. Silver finished last year with gains exceeding 130%. Think about that number for a second. 130% in a single year. It started at $29 per ounce and closed above $70. That's the kind of move that happens once in a generation, maybe twice if you're lucky. And now, barely into the new year, we're already trading above $82 per ounce. The market is screaming that fundamental conditions have shifted dramatically, yet the so-called experts on financial television are still calling this volatility and telling people to stay calm and stick with their diversified portfolio of stocks and bonds. They're completely missing the forest for the trees. The disconnect between paper pricing and physical reality has never been more obvious to anyone actually paying attention. Go try to buy physical silver right now. Actually try it. Call any dealer in your area and ask what they're charging for American Silver Eagles or Canadian Maple Leafs. The premium over spot price is astronomical compared to historical norms. That spread between the paper price and the actual price you pay is the market's way of telling you that paper contracts and actual metal are two completely different things. The paper price flashing on your screen doesn't reflect what it actually costs to put real silver in your hand. It doesn't reflect the reality of limited supply and growing demand. Here's what concerns me about timing and where we are in the economic cycle. Recent economic data showed retail sales flattening in December. Consumers are pulling back on major purchases. They're showing clear signs of financial strain. Credit card balances are at record highs. Savings rates are declining. People are feeling the pressure. And how did the Treasury market respond to this data? Yields dropped. The 10-year Treasury yield fell to nearly a 1-month low. When yields fall, it typically signals that investors are worried about economic growth and are seeking safety. And when that happens, precious metals typically rise. And that's exactly what we witnessed. Gold pushed above $5,050 per ounce. Silver jumped more than 2% in a single trading session. The Federal Reserve is in an impossible position, and this is something most people don't fully appreciate. They're publicly saying there's no urgency to change interest rates, calling the outlook cautiously optimistic. But the bond market isn't buying it. The bond market is much smarter than the talking heads on television. Investors are pricing in at least 2 quarter-point rate cuts this year, with the first one expected by June. That's a complete contradiction to what the Fed is saying publicly. The Fed is saying everything is fine, while the market is saying you're going to have to cut rates because the economy is weakening faster than you're admitting. Somebody's wrong, and history shows us that the Fed is usually the last one to acknowledge when conditions have changed. When they're eventually forced to pivot and start cutting rates, precious metals are going to explode higher because that's exactly what happens in low interest rate environments. Hit that like button if you're getting value from this breakdown. Every like helps push this information to more people who need to see it, and frankly, the algorithms don't naturally promote content that challenges the mainstream narrative. The system is designed to keep you watching entertainment and consumption content, not educational content that might actually help you protect your wealth. Your engagement matters more than you think in fighting against that algorithmic bias. Let me give you some historical context, because this pattern has played out before, and understanding history helps us prepare for what's coming. Back in 1979 and 1980, silver went from under $6 per ounce to $50 in less than a year. That was the famous Hunt Brothers episode where 2 wealthy individuals attempted to corner the market. But here's what people forget about that situation. That squeeze happened because of a fundamental disconnect between paper promises and physical availability. Sound familiar? The difference is that today's disconnect is even larger. The leverage in the system is even greater. The ratio of paper to physical is more extreme, and the number of participants waking up to this reality is growing exponentially. We're not talking about 2 brothers anymore. We're talking about institutional investors managing billions of dollars, sovereign wealth funds representing entire nations, and millions of individual investors around the world, all asking the same question at the same time. Where is the actual silver? Show me the metal. Now think about this for a moment and let it sink in. JP Morgan, one of the largest and most powerful banks on the planet, just released their price forecast for silver this year. They're projecting an average price of $81 per ounce. An average price. That means they expect silver to trade significantly above 81 at various points throughout the year. This isn't some newsletter writer or YouTube personality making bold predictions to get attention. This is JP Morgan, one of the most conservative establishment financial institutions in existence. And they're not telling you this out of generosity or because they want to help the average investor get rich. They're telling you because they've already positioned themselves. The smart money has already accumulated what they want, and now they need retail participation to drive prices higher so they can profit on the move. That's how this game has always worked. I want to address the skeptics because I know some of you are thinking this sounds extreme or too good to be true. You're thinking the COMEX can't actually default because there are rules and regulations preventing it. And you're partially correct. The exchanges do have mechanisms designed to prevent a technical default. They can declare force majeure, which is essentially a legal way of saying extraordinary circumstances beyond our control. They can settle contracts in cash instead of delivering physical metal. They can change position limits. They can modify margin requirements. They can essentially change the rules midstream. And that's exactly what should concern you. Because when they're forced to use those emergency mechanisms, when they're forced to publicly admit they can't deliver the metal that was promised in the contracts, confidence in the paper pricing system evaporates overnight. The price discovery mechanism breaks down completely, and the real price of silver, the price that reflects actual supply and demand for physical metal in your possession, could gap up 50, 100, even 200% literally overnight. We've seen this happen in other commodities. We've seen it happen in currencies. It can absolutely happen in silver. Make sure you drop a comment and let me know if you're already positioned in physical precious metals or if you're still researching and trying to decide. Tell me what's holding you back if you haven't made a move yet. Is it skepticism about whether this is real? Is it not knowing where to buy from a reputable dealer? Is it concerns about storage and security? I read every comment, and I want to create content that addresses your specific questions and concerns. The industrial demand picture is something most people completely overlook when they think about silver, and that's a huge mistake. Silver isn't just a monetary metal that people buy for investment. It's an industrial workhorse with applications that are absolutely critical to the modern economy. Solar panels require silver paste to collect and transport electricity efficiently. Every electric vehicle rolling off the production line uses silver in its electrical systems and components. 5G infrastructure, which is being built out across the country and around the world, relies heavily on silver for conductivity. Defense applications, including advanced missile systems and guidance systems, cannot function without silver's unique properties. The United States military literally cannot build certain weapons and defense systems without access to this metal. And unlike gold, which is primarily held as a store of value and sits in vaults, silver gets consumed. It gets used up in industrial processes. It goes into products that eventually end up in landfills at the end of their useful life. The above-ground stockpiles of available silver are shrinking every single year, while demand continues to grow from multiple sectors simultaneously. Here's another problem that most people don't understand about silver supply. Mining production can't just be ramped up overnight because prices went higher. Silver is primarily mined as a byproduct of other metals like copper, zinc, and lead. There are very few pure silver mines in operation, so you can't just decide to open a new silver mine and start producing metal within a few months. It takes years of exploration, permitting, environmental studies, construction, and development to bring new production online. In the meantime, the deficit between supply and demand continues to grow wider every quarter. Let me show you something that mainstream analysts completely ignore in their coverage: the gold to silver ratio. This is one of the most important metrics in the precious metal space, and almost nobody talks about it on financial television. Historically, going back hundreds of years, the ratio of gold prices to silver prices has averaged around 60 to 1. During periods of monetary crisis and financial stress, that ratio is compressed as low as 15 to 1 as investors rush into silver more aggressively than gold. Right now, with gold trading around $5,050 and silver around $82, the ratio sits at approximately 61 to 1. We're basically right at the historical average. But here's what that tells us about potential upside. If gold stays relatively flat from here and the ratio compresses to crisis levels of 15 to 1, which has happened multiple times in history, silver would have to trade at over $330 per ounce just to reach that ratio. If gold climbs to $6,000, which many analysts expect, and the ratio compresses to 30 to 1, silver would trade at $200. The math is completely straightforward. Silver has dramatically more upside potential than gold from current price levels because of how suppressed this ratio has been for so long. And because the silver market is so much smaller than the gold market in terms of total dollar value, prices can move much faster and much further when capital starts flowing in. Share this video with someone who needs to understand what's happening, because this information needs to spread beyond the usual circles. The mainstream media won't cover this properly until it's too late for most people to benefit. Now let me walk you through what I think is coming in terms of phases. We're currently in phase 1, which is quiet accumulation by informed investors, while mainstream media dismisses the rally as speculation or a bubble that's about to pop. Premiums on physical metal are elevated, but the paper price mechanism is still functioning relatively normally. Phase 2 begins when physical delivery demands at the COMEX continue accelerating month after month. We saw 40 million ounces demanded in January. If that pace continues or increases in February and March, registered inventory could drop below critical levels that trigger alarm bells. That's when the broader market starts waking up and paying attention. Phase 3 happens when the COMEX is forced to use emergency measures to prevent a complete system breakdown. Cash settlements instead of physical delivery, new position limits imposed suddenly, rule changes designed to prevent the system from collapsing. That's when confidence in the paper pricing mechanism breaks completely. And phase 4 is the violent repricing, where the paper price gaps up massively in a short period to reflect physical reality. Premiums collapse because the spot price finally reflects what dealers have been charging all along, and anyone who waited too long to get positioned watches from the sidelines as the opportunity passes. Let me address the dollar situation because it connects everything we're talking about. The United States government is running budget deficits exceeding $2 trillion annually. The national debt is rapidly approaching $40 trillion total. Interest payments on that debt are now one of the largest line items in the entire federal budget, bigger than what we spend on defense. Those interest payments have to be made in dollars. Deficit spending has to be funded with freshly created dollars, which means the supply of dollars in circulation must keep expanding year after year, which means the purchasing power of each individual dollar must keep declining over time. This isn't conspiracy theory or doom and gloom. It's basic arithmetic that anyone can verify. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created back in 1913, and the pace of that decline has been accelerating in recent decades. When you hold physical gold and silver in your possession, you're essentially opting out of that system. You're holding assets that cannot be printed or created out of thin air by a central bank. You're holding wealth that has been recognized as money and a store of value for thousands of years of human history across every civilization. I want to be very clear about something important, so there's no misunderstanding. I'm not suggesting you sell everything you own and put 100% of your wealth into precious metals. That would not be prudent financial planning for most people. What I am saying is, if you currently have zero exposure to hard assets, If your entire net worth is denominated in paper claims backed by paper promises from institutions that are leveraged 30 or 40 to 1, you're taking massive uncompensated risk that you might not even realize. The whole point of proper diversification is owning different types of assets that behave differently in different economic environments. Precious metals are the ultimate hedge against the specific scenarios that would absolutely devastate paper assets. Currency crisis, sovereign debt crisis, loss of confidence in central banking policy, runaway inflation. These are considered tail risks by most financial advisors, but tail risks happen more frequently than people think. We saw it in 2008 during the financial crisis. We saw it in 2020 when the entire system almost froze. The structural conditions are building for another major event. The question isn't if it will happen, but when it arrives, do you want to be protected or completely exposed? Something interesting happened on January 30th that perfectly illustrates how sentiment gets manipulated by the media. A new Federal Reserve chair was nominated, and silver crashed 27% in a single day, while gold dropped 10%. It was a brutal sell-off that shook a lot of people. Mainstream financial media immediately declared the precious metals rally completely over. They said the dollar was regaining confidence and stability. They said the Fed would maintain tight monetary policy indefinitely. They said you should sell your metals immediately and get back into traditional paper assets. And what happened within just a few days? Silver rebounded strongly. Gold rebounded strongly. The sell-off turned out to be a massive shakeout and buying opportunity, not a trend change. The structural forces driving metals higher didn't disappear because of a personnel change at the Fed. The debt is still there, growing every day. The deficits are still there, getting worse. The paper-to-physical disconnect is still there, getting more extreme. Industrial demand is still there, accelerating. Nothing fundamental changed in the actual supply and demand dynamics. But a lot of weak hands got shaken out at the bottom and watched helplessly as prices recovered without them. Before I wrap up, drop a like on this video if you found the information valuable. The algorithm needs that signal to show this content to more people. And engagement is genuinely how we build a community of informed individuals who aren't completely dependent on corporate media narratives that serve Wall Street interests. I've been following these markets closely for years, and I can honestly say I've never seen a setup quite like what we're looking at right now. The paper-to-physical disconnect is at extreme levels that are historically unprecedented. Industrial demand is growing rapidly while supply remains constrained by geological and economic realities. Central banks globally are buying gold at record levels, over 1,000 metric tons annually in recent years, which tells you everything about their confidence in fiat currencies. The Federal Reserve is trapped between inflation and recession with no good policy options available. Foreign holders of Treasury debt are quietly reducing their positions. The entire global financial architecture that was built after World War II is being questioned and renegotiated in real time by major powers. And sitting right in the middle of all this complexity, largely ignored by mainstream financial outlets, is silver. A unique metal that is simultaneously a monetary asset with thousands of years of history and an industrial necessity for modern technology. A metal that is being consumed in industrial applications faster than it's being produced from mining. A metal where the paper futures market has completely divorced from physical reality. Some well-known financial educators are making bold predictions that sound extreme but are based on solid reasoning. Robert Kiyosaki, author of Rich Dad, Poor Dad, and one of the most followed voices in financial education globally, is on record predicting silver could hit $200 per ounce this year. $200. That would represent more than a 150% increase from current levels. His reasoning is straightforward and logical. The fiat currency system is weakening structurally. Industrial demand from solar panels, electric vehicles, and artificial intelligence infrastructure is exploding, and the COMEX is running dangerously low on deliverable metal. Other respected analysts like Clive Thompson have warned that by March, the COMEX could literally run out of silver available for immediate delivery. March is only weeks away from where we are now. The window of opportunity is closing faster than most people realize. Smart money has already positioned themselves. Large institutions are already accumulating quietly. The only question is whether individual investors like you are going to wake up in time to get ahead of this move, or whether you'll be left watching from the sidelines as silver reprices violently to reflect its actual value. The COMEX data is completely public and transparent. Delivery reports are published regularly. Inventory levels are available for anyone to check. The information is sitting there for anyone willing to look beyond the mainstream headlines. All the financial establishment can do at this point is hope you don't pay attention, that you remain distracted by entertainment and consumption and partisan political theater, that you never connect the dots and realize what's unfolding right in front of your eyes. This is Element Axis, bringing you the financial insights that actually matter in the real world. Make sure you're subscribed with notifications turned on so you don't miss the next critical update. Drop your thoughts and questions in the comments section below. Share this with someone who needs to hear this information. And remember, stay informed, stay prepared, and I'll see you in the next one.